You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, last week we took a little bit of a time out to answer some listener questions, so we're going to get right back into it this week. Earnings season was eventful, and we had a lot of fun doing some paper trades around earnings, but now a lot of those dates have passed, and I think I'm going to take this opportunity to talk about a trade that we actually did via our Option Blitz platform, which we do with Dan Sheridan from Sheridan Options Mentoring every Monday afternoon on the Ally Invest WebEx platform. And we actually looked at a skip strike butterfly just in the S&P 500 index, not because of earnings. We had, the VIX is currently trading around 12-13%. We got a little bit of decent implied volatility. It's not down around 10 or 9. We'd like it to be a little bit higher to do this type of trade. But because of this, we decided we were going to just do, instead of a standard short time bomb butterfly that Dan likes to talk about a lot on our Option Blitz, where you really got a huge rate of time decay on these very expensive index options. We're going to actually look at a skip strike butterfly in that S&P 500 index. And now one of the things that makes the SPX a decent candidate for this trade is that there's so many expirations. Now, in hindsight, sometimes that can also mean that you're going to have to deal with a little bit wider bid-ask spreads. But the S&P 500 index is one of the most liquid indexes out there. Unfortunately, you always got to try to fish around exactly for the price. But with that said, we had success on the trade. We put the trade on Monday. It had a Wednesday expiration. So bottom line is this trade went away today from the Monday trade, and I would just go in and put another one right back on. You had success with the trade on Monday. If you followed it, that paper trade, that trade went out fairly well. The market actually ran right almost to the short strike of the butterfly a day before the expiration. And now let's do another one. I like that theme, so let's go with it. So now we can take that one that expired on Wednesday, which is exactly when we're taping Options Playbook Radio, which is Wednesday, August 22nd. The markets have closed, so we're taping right now. So that trade is officially done. There's no way that you could trade it anymore because we use those Friday after at the close PM settlement expiration S&P 500 index options. Gosh, that's a mouth load. But with that said, let's look at another one that will expire on Friday. And that means we're going to get 2 full trading days. We would want to do this in theory. We're doing it on paper anyways. We're never meant to be recommendations here on Options Playbook Radio. We're always just trying to learn scenarios where specific option strategies might make sense. And we're going to look at the August 24th expiration in the S&P 500 index, and they expire at the close on the 24th. So you got the whole Friday expiration. These are technically considered the weekly expirations in the SPX. And if you look at the symbols, they actually have an SPXW next to them to stand for the weeklies. But here's the trade. The S&P 500 index closed at 2861.82. It was down $1.14 on the day. If I look at the most at the money straddle, the long straddle, buying to 2860 call and the 2860 put, if we combine that long straddle will be trading for right around 15 points. So that's the range that we want to stick in. And is it possible for the S&P 500 index to gap open more than 15 points on the opening? Yeah, but there's no major news events around, so we're feeling fairly comfortable. We want to be far enough away from where the current market is at that the move could happen, but we don't want to have the huge gap opening because that's where all of our risk is going to be. We're going to do a 5-point wide butterfly, and we're going to skip a strike, and we're going to try to get this entire trade done for very close to even. So when we skip a strike in a skip strike butterfly, otherwise known as a modified butterfly, I like skip strike better because you're literally skipping a strike. What happens is you end up embedding a credit spread inside the butterfly. And the whole goal is that credit spread actually pays for the cost of the butterfly. Now, downside is if you embed the credit spread, well, you are adding risk because credit spreads, you do them for a net credit to the account, and your risk is the width of that spread less the credit received. So in this instance, on a normal butterfly, the net debit that you pay for the trade is how much risk you have. With a skip strike butterfly, it would be the width of that credit spread, which is 5 points in this instance, minus any credit received or plus any debit paid. In our instance, the market at the midpoint is quoting even for the trade. So we're going to hopefully get this done for even. I would like to get it done for a small net credit to the account, maybe a nickel. That would be wonderful to try to cover the commissions. But even I'll take. So here's our trade for the week. Skip strike butterfly in the S&P 500 index weeklies. You got 2 full days of trading, not meant to be a recommendation, but on paper, here's what we'd look to do. Market's at 2861.82. We're going to go 15 points up from the 2860 level, and we're going to buy the 2875 call, sell to open 2 of the 2880 calls, and then buy another. We're going to skip the 2885, and then we're going to buy the 2890 call. So 1 by 2 by 1, skip strike butterfly. Maximum risk here is $500. The market's got to get all the way up to 2890 to lose that maximum by that expiration date. So that would be $5. We're doing this entire trade. We're going to enter it at a even point, which basically means we pay 0 for it, but we got commissions, and we got a lot of commissions because we're talking about a 3-legged trade here. So our maximum risk is at 5 points or $500. Our maximum upside is also 5 points, but ideally we will never get the maximum because that would mean it'd have to go out right at the 2880 strike, right at expiration for that to happen. On the downside, though, our profit and loss graph is very interesting in this trade in that if the market just stays where it's at or goes south, well, if we get this entire trade done for an even or for 0, well, we have no risk on the downside, or if the market just stays where it's at. Anywhere below our first long strike, which is the 2875 level, we basically break even on the trade. We're just going to be out commissions. If the market starts creeping up, we hope that it does it closer to the expiration date. If it starts creeping towards the 2880 level, at that point in time, eventually we're going to have a positive delta trade, and we would like to see this ideally open on Thursday, maybe trade fairly, go up about 10, 12 points, start trading towards the 28.75 level. And then on Friday, it's trading between 28.75 and 28.80. That would be our best scenario, which we just had happen last week, actually, in our last skip strike butterfly that we did. Now, if you do this trade, you're going to set an alert at 2880 in the S&P 500 index, because you want to know if that index hits your short strike. And if it does, you just want to get out of that trade. You could be profitable if it's closer to the expiration date. You may even be down a few cents if it happens right away in this trade. You need time decay to happen for you in order for this trade to be profitable. So you want to know if it hits 28.80. If it does, you're going to get out of the trade. You don't want this skip strike butterfly to go against you. You don't want to get to the point where the credit spread embedded in that skip strike butterfly is hurting you. And it's a big deal because this is a very, to use Dan Sheridan's words, it's a time bomb skip strike, in that the time decay in the S&P 500 options from Wednesday to Friday is huge. I don't care what theta says or any pricing calculator. Just from my many years of trading, I know that 2880 call has time value in it right now, but it's got to get to zero, right? It's got to go away no matter what it's trading for right now. Eventually, it's got to be at zero. So to summarize, let's go through it real quick. We're doing a skip strike butterfly in the S&P 500 index this week. That's our paper trade. The market closed on Wednesday, August 22nd at 2861.82, down $1.14. We went into the S&P 500 index, bought the August 24th expiration, 2875 call, sold two of the same expiration, 2880 calls, and then bought one of the 2890 calls, 1 by 2 by 1. Did it for an even midpoint fill. If we can get that fill at that price, max risk is $500. Our max upside is $500, and it's a 2-day trade. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. And please check out our WebEx platform over here at Ally Invest. It's allyinvest.webex.com, allyinvest.webex.com. And thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.